Hi everyone, my name is Prasna Gautam and today I will be presenting the financial analysis for the Bullock gold mining case from Chapter 7. The goal of this case is to determine whether the company should invest a new gold mine based on the several key financial tools. So let's see the background of this case. So here is the background information of the case. So Seth Bullock is the owner of the company and he is considering to open a new gold mine in South Dakota. So after analyzing the site, the company's geologist Dan Doherty believes the mine would be productive for about 8 years before the gold runs out. So Seth asks Alma Garrett, the company's financial officer, to do analysis and decide whether opening new mine would be the best financial move or not. So she will estimate the cost and required rate of return and then analyze the project using financial tools. So let's move to the case data. So let's see the case data. So in this case we have the following data. The company will incur 750 million investment in the first year to start the mine, which is initial investment of the company, and over the next 8 years the mine is expected to generate significant revenue. Here we have some cash inflows from year 1 to year 8. For the first year there is expected cash inflow of 150 million, and in second year there is expected cash inflow of 180 million, and in third year there is expected inflow of 195 million, and in fourth year there is highest expected cash inflow of 235 million, and after the fourth year the cash inflow begins to decrease, and in fifth year it it is expected to be 220 million, and in sixth year the cash inflow is expected to be 185 million, and in seventh year it is 165 million, and in the eighth year there is expected cash inflow of 145 million. So in the ninth year, the company will incur 105 million cost for the mine closure and reclamation. So this is the one-time cost for shutting down the mine. So the Bullock has a 12% required rate of return. So using this data, we'll analyze the project. So let's see the spreadsheet of the data. For payback period, I have calculated cumulative cash flow at which the break-even point is in between year 3 and 4. So the payback period is calculated in year 3.96, which means the investment is recovered just before the end of year 4. For internal rate of return, I used IRR function and got 17%. For modified IRR, I used reinvestment method and calculated future value of all positive cash flow and present value of all negative cash flow, and we got MIRR of 13.91%. So for the NPV we got almost 129.5 million at the required rate of 12%. So let's analyze each financial methods. So when we use IRR analysis, the company will be profitable when IRR exceeds the weighted average cost of capital, that is WACC. So according to this case, we have got IRR of 17% and we have required rate of return 12%. So as you can see that IRR is greater than the required rate of return, so the company will be profitable. And the 17% of IRR means that for every dollar you invested, you are getting back the dollar plus a 17% annual return, which is higher than 12% cost of capital. So the company will be profitable. So let's move into the next analysis. So when we do NPV analysis, we need to make sure that the NPV must be greater than 0. NPV provides a clear decision rules, that is, accept investment when there is positive NPVs and reject those with negative NPVs. Since the project has positive NPV of almost 129.5 million, which shows that the company will have profitable investment. So the next analysis will be modified internal rate of return analysis. For the modified IRR analysis, I used reinvestment approach. So we got MIRR of 13.91% and we have required rate of return 12%. So since MIRR is greater than weighted average cost of capital, the company will be profitable. So for MIRR, I calculated future value of all positive cash flows using required rate of return 12% and present value of all negative cash flows and use the MIRR formula. In this investment scenario, our calculated MIRR of 13.91% exceeds our required rate of return 12%, suggesting that this investment creates value. The spread of 1.9% represents the project's excess return. So the next one is payback period analysis. Payback period analysis means when we will recover our investment. So from this data, we'll find that the investment will be recovered in 3.96 years, which means almost 4 years. So for this calculation, I use the cumulative cash flows and find out that the investment will be recovered in between year 3 and 4. So this payback period of 3.96 years indicates relatively quick recovery of initial investment. So this is typically considered good for a large capital project. So payback period of less than 4 years suggests this project has good liquidity characteristics, with capital being freed up for the other investment relatively quickly. So let's move into the recommendation part. So based on our comprehensive financial analysis, we recommend moving forward with this investment project first for the following reasons. First one is the net present value, which stands at a strong 129.5 million. That indicates substantial value creation for the company. And the second one is internal rate of return, that is 17%, which is 5% above the required rate of return. This provides a healthy margin of safety and reinforces the project's potential profitability. And the third one is the payback period, that is 3.96 years, a relatively short time frame given the size and scale of the projects, allowing for quicker capital recovery. And lastly, modified internal rate of return, that is 13.91%, which also exceeds our required rate of return, that demonstrates the project's attractiveness even under more conservative reinvestment assumptions. So together with all this financial analysis, we can say that this gold mine company will be profitable and it is a good opportunity for the investment plan. Thank you. Have a good day.